AppLovin was one of the top performing stocks in 2024. In fact, it 8x'd in 2024, so it was up over 700%. And today it's down 16% after a short selling firm called Muddy Waters released a short report on the company. So let's just dive right into it. So AppLovin is an advertising and monetization company for, as the name suggests, mobile apps. And Muddy Waters claims that they're not all they're cracked up to be. For one, Muddy Waters claims that over half of AppLovin's e-commerce revenue is from retargeting. Retargeting is essentially reaching out to people who have already shown interest in a product. So they're saying that AppLovin is giving people old leads disguised as new leads. That's not all. They also claim that AppLovin is collecting user IDs from its key partners, which is a major violation of their platform's terms of service. So potentially they're saying that AppLovin is doing a lot of shady things and could possibly be on the hook for those shady things. They also claim that partners are catching on to this and there's been significant churn within AppLovin's partners. So if that's all going over your head, I think it's important to talk about what AppLovin does. So like I said, AppLovin is a monetization company. I think the easiest way to think of AppLovin is, let's say you're using a free app and one of those ads comes up that you have to watch for 10 seconds before you can skip it, kind of like this here with the cards. That's AppLovin. And yes, those ads are extremely annoying, but you have to admit that you probably know what I'm talking about, right? I think everybody who has a mobile phone has seen these types of ads. So I put together a little PowerPoint here on AppLovin just to show how they compete with some other companies that I've covered on my channel before. So they compete with Unity Ads, and Unity is a mobile app and video game software development platform. They made an acquisition called IronSource, which sort of boosted their advertising offerings. And so they compete in that mobile advertising segment with AppLovin, Unity does. And AppLovin also somewhat competes with a company called The Trade Desk, which does programmatic digital advertising. Essentially, they're using AI to get the right ads into the right place for the right price. AppLovin does a bit of that too with their Max platform. They have this unified auction, which is very similar to what Trade Desk does, and it is said to boost ad revenue for companies. So an example of when you might use AppLovin, let's say you are a game developer and you've developed this awesome mobile game, but nobody is playing it. It's just sitting there in the App Store. You can't get anyone to play it, even though it's a great game. You would use AppLovin to increase your active users and also to show ads to increase your monetization. So not only can you get people playing your app, you can get people watching ads that will give you money. So even if your app is free, you can still make some money off of it, right? And pay for hosting services, pay for developers, whatever you need to do. So AppLovin really is kind of becoming the backbone of the App Store. However, if these claims by Muddy Waters are true, their stock could be in trouble. Now, like I said, the stock was one of the top performers of 2024. And it's actually sunk quite a bit from its peak. So from its peak, it's down almost 50%, but in the past year, it's still up 300%. So this is a real head scratcher. Is this an overvalued stock? Is this an undervalued stock? Well, let's take a look. So ignoring the Muddy Waters claims for a second, there's a lot to like about AppLovin. This is my high quality company spreadsheet where I rate growth stocks on various factors. The spreadsheet has gotten an update, but the factors and scoring are all still the same. Here's AppLovin here, and we can see that compared to the other stocks I look at, AppLovin scores very highly. The average stock score on my spreadsheet is around 12, and AppLovin gets a 14.4. So essentially my spreadsheet is saying there's a lot to like about AppLovin in terms of growth, valuation, margins, and all that. So let me break it down for you. So AppLovin is a $92 billion company. This places them as the same size as CrowdStrike, which supplies endpoint security to some of the most important organizations in the world, and two of the large semiconductor manufacturing equipment companies, Lam Research and KLA. AppLovin is valued the same as those companies. It's impressive. AppLovin has over $5 billion in annualized revenue. I took their last quarter, multiplied it by 4, $5.5 billion. That's very impressive. And of that $5.5 billion, 74% comes down to a gross profit. So all that means is that the costs associated with that revenue is about 26%. The other 74% can then flow to the next step before going into a profit. So the next step, they have to pay SG&A, which is selling, general, and administrative. That's things like paying their employees, paying for advertising, which is kind of funny that an ad company has to advertise, but they do, and research and development. So this is somewhat of an AI company, right? They have their own AI algorithm that they use in order to facilitate pricing and bidding for their ad platform. they do have to spend a bit of R&D money on that. So together, between SG&A and R&D, that costs about 46% of their gross profit. So 50% of 75% of their profits, right, hits the bottom line. So this is a very, very profitable company. For reference, they had a net profit margin of 44% last quarter. That's very impressive. Some of the most profitable companies in the world have profit margins around there. So this is definitely nothing to sneeze at. Looking at other metrics, we can see that I did highlight here in red, they have a high long-term debt to equity ratio, which means that they do have a lot of debt compared to their shareholders' equity. Shareholders' equity is simply assets minus liabilities. Assets are things of value, liabilities are debts. They have an internationally diversified revenue stream, so 43% of their revenue comes from outside of the US. So this is not a US dependent company. They do have a broad range across the globe, and they showed 44% quarterly year-over-year revenue growth last quarter. That's insane. I mean, that's great revenue growth for a company that's almost $100 billion in market cap. Now, a couple bad things about AppLovin, their valuation. On a price to annualized sales, their valuation is about 17. So this is a high valuation, no matter how you look at it. We can see, comparing it to some other companies on this list, they're valued higher than Snowflake, which is usually quite expensive, and they're valued higher than Palo Alto Networks, which is a cybersecurity company. So they're definitely not cheap, but when we think about the growth that they're showing, perhaps this valuation might be merited. They also have a slightly high PE ratio, so despite being very profitable, their price to earnings ratio, that's simply their market cap divided by their annual profits, is about 62. That's about double the NASDAQ, but then again, they're showing more than double the NASDAQ's growth. So again, maybe that's warranted. Price to free cash flow I like a lot better. It's at 46. That's not unreasonable at all for a growth company. So they're making more free cash flows than they are in profits. That's great. That's great. As Buffett says, profits are an opinion, cash is a fact. So that's what I mean when I say that there's a lot to like about AppLovin financially. And one thing that my spreadsheet doesn't talk about is their shares outstanding, which have actually been decreasing over time. So normally growth companies will be issuing more shares to pay their high-level employees. AppLovin's doing the opposite. They've been buying back shares, which is great if you're a shareholder. That means your equity in the company is growing without you having to do anything. And the stock went up 800%. So the fact that they're not selling shares after such a meteoric rise is great for shareholders. I just really love to see that. So I talked a bit about their high debt to equity ratio. So let's dig into that for a second, and then I'll go over my thoughts on AppLovin and if it's a buy today. So this is AppLovin's balance sheet as of the end of 2024, the most recent quarter that they reported. We can see that they do have a lot of debt. So they have total liabilities of almost $5 billion, and they have total assets of about $6 billion. So, you know, that's not bad. I love that their assets are greater than their liabilities. When we go into current assets and current liabilities, the picture looks a lot better, however. They have current assets of $2 billion and current liabilities of $1 billion. Current assets are things that can be turned into cash within a year. Current liabilities are debts that come due within a year. So this means that they can pay off their short-term debts with their short-term assets twice over. That's pretty great to see. What I don't like to see is the long-term debt. So, you know how I said they have $5 billion of liabilities and $6 billion of assets? Well, the $6 billion assets is a bit misleading. Of that $6 billion, about $2 billion is in goodwill. So if you're unfamiliar with goodwill, essentially when one company, let's say AppLovin, acquires another company, let's just call it Company B. AppLovin acquired Company B for, let's say, $10 billion, but Company B was only worth $8 billion. The $2 billion that they overpaid is now recorded as goodwill on AppLovin's balance sheet. So it looks like an asset because they paid $10 billion for something. Surely it's worth $10 billion. But it wasn't really worth $10 billion. It was worth $8 billion. So they have to find a magical bucket for this intangible asset, which is called goodwill. So it shows up on the balance sheet and may artificially inflate their total assets. So all that is to say, if we take out goodwill and intangible assets, they actually have fewer assets than they do liabilities. So looking at this critically, I would say that their balance sheet is not very good. They're kind of underwater on their balance sheet because realistically, goodwill isn't really worth anything and intangible assets tend to be overstated. So that is one gripe that I have with AppLovin. Besides the potentially high valuation, their balance sheet is not amazing. Let's get back to the Muddy Waters short report and I'll tell you if I think this stock is a buy or not. So Muddy Waters, I'm familiar with this company. I have been investing in individual stocks for quite a long time now, and Muddy Waters publishes a lot of research. They're not perfect, they're not bad, but as with most short selling reports, you kind of need to take these with a grain of salt. Here are some of their recent short reports, and we can see that they post a lot of them. In fact, there's a new short report pretty much every month. Some of these were spot on, some of these were far off, right? So I did a video on dLocal talking about the short report that Muddy Waters made on dLocal. I wouldn't say they were right. The stock is down, but not for the reasons that they called out in their short report. So maybe that's a win, maybe that's not. It's a very interesting career path, right? To try to uncover dirt on companies, short them, and hope people sell them. But for what it's worth, I think they do tend to do their research. Some of the claims that they make against AppLovin are that their technology is not anything unique. They're saying that Meta and Google, very, very large advertising companies, already have similar technology that they're using, sort of implying that AppLovin doesn't really have a moat. They're claiming that some of the data that AppLovin uses in ad auctions was actually not obtained legitimately. So they're saying that they're using data that they're not allowed to use in order to train their AI algorithm in ad auctions. That's very possible. But again, these types of things need to be taken with a grain of salt. As of recording this, AppLovin has not responded, but a lot of times what you want to do is wait and see if the company issues a response to a short report. Typically, a company will see its stock down something like 16% on the day, 20% now, and the CEO will make a statement basically saying why Muddy Waters is full of mud, right? And AppLovin has yet to do that. Now, factoring in everything that we know about AppLovin and the short report, do I think AppLovin is a buy today? Personally, I think that there are better advertising technology companies out there, but I don't think AppLovin is a bad buy. So on my channel, I don't recommend stocks. I don't tell people you should buy this, you shouldn't buy this. I try to give all the information and then give my opinion, and then hopefully my viewers will come up with their own opinion as to what they want to do. I think everybody's investing journey is different, and what's a buy for me might not be a buy for you, and vice versa. So for me, I'm going to put AppLovin on my watch list. I'm not going to discount it yet, but I'm not quite interested in opening a position. For one, I did open a position in Trade Desk recently, and I've been buying the dip on that. That is another advertising technology company, and I also own Alphabet, which is a very large advertising technology company. So AppLovin is not necessarily something I need exposure to right now, and with the market we've been having, a lot of these other companies are also beaten down, and I just have higher convictions in them. Every time you buy a stock, you're choosing not to buy another stock, right? Because that's capital that you could put into something else that you're choosing to put into, say, AppLovin. For me, I'm not ready to risk that opportunity cost yet. However, if I was someone who was sitting on a lot of cash right now and wasn't sure where to put it, AppLovin does look pretty attractive. Besides the slightly high valuation, they're executing very, very well. So like I said, revenue is up 44% year over year. They have over $5 billion. They have amazing gross and profit margins, and they're generating a lot of cash and buying back shares. Those are things that you really want to see in a thriving business, and AppLovin checks all of those boxes. So I know this was a bit vague. I'm not personally buying it yet. I'm going to keep my eye on it. But if you're interested in it, more power to you. That's what I have to say. What do you guys think about AppLovin? What do you guys think about the short report? Is it full of mud or is it legit? Let me know down below. If you're new here, please subscribe. I post stock analyses and deep dives on a regular basis. If that's something you like, then hit that button. Thank you guys so much for watching and have an amazing day.